Is the real estate market overvalued? I would argue it is. I would also argue that doesn't mean you avoid it. Welcome to How to Retire on Time, a show that answers your retirement questions. We're here to move past that oversimplified advice you've heard hundreds of times. Instead, we're going to dive into that nitty-gritty. So as always, text your questions to 913-363-1234 anytime during the week, and we'll feature them on the show. Just remember, not financial advice. This is an educational show. What do we got today?
Hey, Mike, the stock market seems overvalued. Do you think the real estate market is also overvalued? Interesting question.
Great question.
Yeah.
So the biggest assumption here is that there's an inverse correlation between the stock market and other markets. Now, to be fair, JP Morgan, I think it was JP Morgan, did an interesting bit of research that found if you take your traditional portfolio of stocks and bond funds, and I say bond funds, they're not buying bonds, they're buying bond funds, okay?
Okay.
Funds that actively trade bonds.
Okay.
They're different. But you take your typical portfolio and then you add in around 30% in alternatives, and their definition of alternatives was real estate or just other things you can invest in, okay? That they showed a potential increase. Historically speaking, there was an increase in returns and a decrease in volatility. So it was a more predictable way to grow your money. What's interesting about that is many people do not invest in the real estate market. It's just the stock market and the bond market. The problem, though, with this assumption is that it assumes that the different markets will inversely correlate, as in they'll do the opposite. So let's break it down first, the stock-bond relationship, and then we'll answer this question.
Okay.
Because you need to have context here.
Mm-hmm.
The reason why the stock-bond fund portfolio, 60-40 split, won a Nobel Prize and was considered very profound, even though the guy that invented it, Harry Markowitz, never actually used it, is because it was a simplified way that people could invest in the market and hold for a long-term period of time. A great way to grow your money and emotionally be able to stomach the ups and downs. Okay?
Mm-hmm.
So why is that the case? When the stock market crashes, usually the Fed will drop interest rates. If the Fed drops interest rates, that makes money cheaper, which helps the overnight lending or short-term loans, the banking system, which makes it money cheaper, which can put more money back into the economy. Okay? Now, this is not connected, but many people will argue that there is a not correlation, but a rhyming scheme, okay, that if the Fed drops rates, that the 10-year Treasury and other longer-term bonds will also decrease. If new bond issues, new bonds coming to the market are at a lower rate, then the other long-term bonds that you previously held become more valuable.
Yeah, because they pay a higher rate.
They're paying a higher rate. You can't get that anymore.
Yeah, okay. So I'd see why,
So,
yeah.
I mean, imagine you had a card to McDonald's from the 90s, and you could buy Big Macs for 99 cents.
Oh, yeah.
And that was a lifetime deal that for the rest of your life, you could buy a Big Mac for 99 cents.
Good deal.
Today, that's pretty good.
Yeah.
Or you could buy, what is it, $7, $8? Actually, I don't go to McDonald's often. I'm not above McDonald's.
Right.
Love McDonald's. I just don't go as much.
Yeah. I'm with you.
But
It's probably not 99 cents.
it's no, it's not. But imagine you had that deal.
Yeah.
Right? So the same thing is if you had a bond that was paying 6-7%, let's say, or let's be more realistic, 4 or 5%, and now all the new bonds were paying out 2 or 3%, your bond is worth more.
Yeah.
So that's why when new bonds decrease in value, your older bonds become more valuable because they're paying at a higher rate. That's a very complicated thing, but this is why it's so important, is that's usually what happens. However, if you look back at 22, 23, the markets were kind of going down. They're getting hurt. The Fed was increasing rates, right? They're supposed to be inversely correlated. The Fed was increasing rates. Bond issues were also increasing in value. They're increasing in value. And so the problem was all the other bonds were worthless. The stocks went down and the bond funds went down at the same time. They weren't inversely correlated.
And this happened. Did you say this did happen?
Yeah, it was recently.
Yeah. Okay.
People were saying, why are my bonds losing money and the stock's losing money?
Yeah.
Aren't they supposed to be inversely correlated? They're
Right.
not. They're separate. And if you look back at England over the last couple of months, their version of the Federal Reserve has been decreasing their rates, these short-term instruments, while the bonds or their version of the Treasury they haven't done very well. They've stayed high. They haven't gone down, so it hasn't been the normal system, the normal pattern. They're not correlated. They just kind of influence each other. And so the stock bond fund mix is a great idea and often works, but it doesn't always work.
Okay.
Okay? They both can crash at the same time. They both can grow at the same time. They can offset each other as well.
So almost anything could happen, it sounds like.
Yeah. Yep. And
All
we're
right.
in very interesting times economically speaking.
Uh-huh.
So the reason why I bring that up is the real estate market is a good hedge against inflation. It is an uncorrelated market, but it's not inversely correlated. So the stock market in 2008 and the real estate market both crashed at the same time, but bonds
Right.
did really, really well,
Okay, right.
or bond funds specifically. So there are other times, like 2001 and 02, for example, the stock market crashed, bond funds did really well, and real estate did really well. So it's not about finding the opposite or the inverse. It's understanding that there are different independent markets that will affect the underlying financial economic situation. And when you start to understand how that really works, then you can make more educated decisions on how to put together a portfolio.
Okay.
And let me just give you the different markets to consider, and I'll define them just for
Okay.
fun. Does that
Yeah.
sound good?
Yeah. That'd be helpful.
So the stock market or the equities market,
Yep.
it's just think businesses. You're buying a share of a company. In my opinion, the intention of that would be to hold it for a longer term period of time, because the equities market can go flat for 10 plus years at a time. It did in 2000, it did in 1966, it did in 1929, it did in 1906, and it could happen again. It probably will happen again. I would be willing to bet that everyone entering retirement right now, 1/3 of their retirement, if they live 30 years in retirement, will probably be flat in the equities market. That is my bet.
Mm.
I'm not promising it. This is speculation,
Yeah.
but I'd be willing to bet that that is a very real possibility. And that's challenging. Can you imagine not growing any of your money for the first 10 years of your retirement?
Whew, that'd be tough.
How do you hedge against that? So then you've got the bond market. The bond market is the largest market,
Yeah.
okay? America was built on debt.
Yeah. That seems like bad when you hear it, but then you realize, well, I mean, that's what they...
Get Ramsey out of your head for a second.
Yeah,
There's good
right.
debt and there's bad debt.
Right.
Ramsey talks about, Ramsey talks about all debt, but read
Yeah.
my Kipling article about good debt, bad debt. They're
Okay.
different.
Yeah.
Good debt is debt that is tied to something that is appreciating in value.
Mm.
You appreciate the debt with your house because your house should be appreciating in value. You don't appreciate debt tied to your car because your car is depreciating in value. Your credit card debt, it's not just depreciating.
Ugh.
There is no value,
Yeah.
which sucks.
Yeah.
And there's fees on top of it, so you get hit by a double whammy. So understand the difference of debt. And that's an important lesson too as you're going into retirement. Do you pay off your mortgage when you retire or not? Technically, you shouldn't from a financial standpoint as long as the rates are in your favor, but it's okay to pay off your debt anyway if you feel better because you want to be able to sleep well at night. Anyway, so that's the bond market. The bond market is the biggest market and it affects most all other markets. It is the foundation of the American economy, debt. Okay.
And so debt for the federal government, state governments, local governments.
Yeah, this is so.
Have I opened a rabbit hole?
Oh man. All right. To everyone that thinks the government should be run like a business,
Uh-huh.
I'm here to tell you that is factually not true. Because if that were a case, the government then should try to make a profit off the American people.
Yeah.
Can you imagine the government, the very entity that can tax you, trying to make a profit off of you?
Seems like a bad deal.
The purpose of the government is to absorb unnecessary risks and try to stabilize a society. That's why we have, the military to stabilize us from invasion.
Yeah.
That's why we have a judicial system to stabilize internal conflict. That's why we have laws to stabilize the society. The purpose of the government is to stabilize the society, and a part of that is stabilizing the financial sides of our economy. That treasuries aren't necessarily a good or bad thing. Now, hold on. Before you hate on everything I've just said, yes, the debt's got out of hand. I agree the debt is too high. But running a government surplus isn't necessarily the goal. If the government surplus were to happen, that'd be a very nice thing, and then we could lower taxes. I'm not talking about an efficient government. I'm saying that a government's job is not necessarily intended to be run exactly like a business. It is its own thing. That's like saying Social Security is an investment. It's not. It's an insurance plan that the government imposes on us, whether you like it or not. So you might as well make the best of it. I'm not supporting big or little government. I'm not supporting more or less taxes. I'm not in favor of high debt, and the debt is very much getting out of hand. And if you look at Ray Dalio's research on governments and when debt spirals out of control, it is the sign of the downfall of that government, not the collapse, but that it loses its global economic power, and then the power shifts to another country. Look at throughout all of time, the Roman Empire, the British Empire, any empire, debt was the canary in the coal mine. So I am in harmony with lowering the debt. I'm okay if the government doesn't have zero debt. I don't think most people are hung up on if there was like, I don't know, $20 billion of debt.
Yeah.
That's like nothing for our GDP.
Right.
Right. But so anyway, you need to make sure you define government different as a business. There are things that are similar, but they're not the same entity. And that's a very important distinction. Okay. So stock market, bond
market, all kinds of debt.
Then you've got the Federal Reserve driven market. So you need to understand the Federal Reserve does not affect the bond market. The Federal Reserve affects your high yield savings, your short term bond, or like bills, for example, or short term fixed instruments, CDs, will be affected by the Federal Reserve. Short term fixed annuities, Federal Reserve.
Okay.
Short term.
Very short.
Not long term.
Okay.
It's 5 years or greater. It's probably more on the bond market side, not directly correlated with the Federal Reserve. And you need to know the differences there. Then you've got the commodities market. Commodities market, I mean, if you're invested in commodities, soy, oil, gold and silver, I would put in the commodities market. Some people would say they're alternative. I would argue they're more commodities, but that's my opinion. The real estate market is its own market doing its own thing. Then you've also got the currencies market, and I would include cryptocurrencies in that, foreign exchange, cryptocurrencies, all of that. You got the alternative market, so collectibles, your cars, just the art, all of that. That's its own market as well. You've got the private market. The private market, its own version of private equities, private debt or credit, private. So that's a whole.
So it's not
rat's
publicly
nest as well.
listed for everybody. It's private, and you have to somehow get in through some kind of accreditation or I don't know.
Yeah. I mean, you have to go through an advisor.
Yeah. Okay.
But yeah, it's the private market. It's just a different way to look at the different instruments within these different markets.
Is private markets like higher risk?
Yeah.
Would you say? Okay.
I would argue it's higher risk. Risk being a very relative term here, but because you've got less liquidity in the investments that you have.
Okay.
You have to be an accredited investor to even qualify, and that the reason is because if you're an accredited investor, you should know what you're doing. Even though many don't.
Yeah.
That's not a criticism to accredited investors.
Sure.
It's just saying, like, I might be a healthy person. Doesn't mean I'm smart with medical knowledge.
Yeah.
They might have a lot of money. Doesn't mean they know how to do a deep dive into the financials of a company. They might have made their money. I mean, I had one guy that made his money in waste management. Many, many, multiple millions of dollars.
His name wasn't Tony Soprano, was it?
No.
Okay.
It was legitimate.
Oh, yes. All right.
But and then you have the contracts market. Now, the contracts market's one of the more complicated ones. That's where you've got your insurance products. That's where you've got your buffered ETFs. That's where you got your structured notes. That's where you've got your options trading. It's just a different breed. And it's really, in my opinion, the underlying price of the option contracts or the various contracts that make these investments or products possible.
I see.
But you've got many, many different markets. All of them are uncorrelated. They might influence one or the other. There might be a flight to safety. So if one's going down, money might go to another market. But it doesn't mean that they're inversely correlated. They're their own thing. When you understand these differences, then you can more diligently put together a portfolio that would match what you're looking for. Now, back to the question, is the real estate market overvalued?
Yeah.
I would argue it is.
Okay.
I would also argue that doesn't mean you avoid it. Just like you don't avoid the stock market because it's right now overvalued, understand the timeline of the investment. Real estate's not a short-term investment. So if you want to get into real estate, you understand how to get into real estate, whether it's a traditional real estate, you're buying a rental, whether it's something more along the lines of like a privately traded REIT, for example, a Delaware statutory trust, or whatever mechanism you want to get into real estate, that's fine. Know what you're invested in, know the risks associated with it, and know the timeline. Real estate's more of a longer-term play, in my opinion. Shorter term means you've just got more protection in whatever the mechanism might be. CDs, buffered ETFs, whatever you want. If you need money in the short term, you don't go into real estate. You don't go into stocks. You go into safer investments. If you have a part of your assets that you don't need to touch for 10 years, then you might go into these other markets. Does that make sense? Like risk is more of a time question. When do you need the money?
That makes sense.
So any other questions on any of these markets? Here's the quick review. Stock market, bond market, the Federal Reserve driven market. You've got the real estate market, commodities market, the contracts market, the currency market, the private market, and the alternative market.
Yeah. Those are a lot of markets. I mean, some of these
and there's markets within the market.
Oh, wow. That sounds like another rabbit hole.
Yeah, maybe for another day. but the point being is you can become wealthy in any of those markets. You just have to understand which tools are intended to be used in different places. That's the big takeaway.